Alternative Investments Roundtable. Our August virtual event is the Economic Outlook, the Fed, and the Implications of the Financial Markets. For those of you who don't know me, I'm Kunjan Mehta. I am the Vice President of the Roundtable, and we're glad to have everyone join us. First of all, big thanks to our sponsors, without whom this event would not be possible. We have a great group of sponsors who are listed on the screen right now, and they're very actively involved. So it's great to have such a sponsor base. A couple of logistical issues. Please make sure to mute your phones or your computers when the event is in progress. As well as there is a chat button on the bottom of your screen. If you have any questions, please type your questions up on the chat window and send them through to everyone, or to Britt Tunick and myself, as well as Ali, and we're happy to put the question through to Bill. With that, we are honored to have William Dudley as today's speaker. William is currently a senior research scholar at Princeton University. You may know him better as the former president of the Federal Reserve Bank of New York, the vice chairman of the Federal Open Market Committee, and a member of the BIS Board of Directors roles. He has held from 2009 to 2018. At the BIS, he chaired the Committee on Payments and Settlement Systems and the Committee on the Global Financial System. Prior to serving as president of the Federal Reserve Bank of New York, he was an executive director of the Markets Group at the New York Fed and was the chief U.S. economist at Goldman Sachs. So Bill, thank you very much for making the time for the roundtable and being here with us. Ali Toko will be serving as today's moderator. For those of you who don't know her, Ali is the current president of the roundtable and was most recently a managing director of fixed income asset management firm, Good Hill Partners, where she focused on business strategy. Prior to that, she spent several years as an MD at JP Morgan on its prime brokerage management committee. Ali is also a member of the National Board of Directors of the Lymphoma and Leukemia Society and the Youth Development Committee of the New York City chapter of YMCA. So without further ado, welcome everyone again. Ali, please feel free to take this over and welcome.
Ali, excuse me?
Now we can hear you.
We're having some technical difficulties. Ali, you're on mute.
Hello, can everybody hear me?
Yep.
Yes.
Okay, and it's clear? Okay, sorry about that. Bill, thank you, welcome. We're going to turn it over to you, and we look forward to your thoughts, and then we're going to take questions from the audience.
Okay, great, thank you. So I thought I'd spend maybe 10 minutes just talking about the economic outlook, the Fed and markets. The economic outlook, I think, is actually probably a little bit more challenging than maybe what's priced into markets at this point. Obviously, it depends on the course of the pandemic, but even there, we're not really doing a good job as a nation of maximizing the trade-off between the economy and getting control of the virus, because we're not social distancing well, we're not wearing masks well, we're not testing well with rapid turnaround, and we're not doing tracing very well. So, if you think of there's sort of this efficient frontier of trade-offs between shutting down and distancing and economic performance, we're well inside that efficient frontier. Second reason to be a little bit pessimistic about the economic outlook is the fiscal situation right now. We're faced with a really big fiscal cliff that we're basically going off right now. You look at the three biggest elements of the fiscal stimulus. There were the Paycheck Protection Program, the payments to households, and unemployment compensation insurance benefits, and all three of those are either finished or they've lapsed. So lots of fiscal stimulus through the end of July, very little fiscal stimulus starting August 1st. The president's executive orders don't really do much to fill the gap. I mean, I think they're designed to basically try to push the Democrats back to talk to the Republicans about a deal. We'll see how that plays out. But for right now, we're living in a world where fiscal policy went from very stimulative to virtually nothing supporting the economy. And that's really important because that's what's basically been repairing the income hold for households and corporations. In terms of monetary policy, I think that's where things have been a bit more successful. I mean, the Fed has lowered interest rates to zero. They've bought a lot of treasuries and mortgage-backed securities. They've introduced a whole realm of special liquidity facilities that have restored market function. And I think they've done sort of what they could do. I mean, they basically made markets work and they've made financial conditions very accommodating. But at this point, there's really not much the Fed has left to do that can replace the damage caused by the falling off the fiscal cliff. The Fed, basically people expect the Fed to keep monetary policy on hold for years. The Fed expects to keep monetary policy on hold for years. So short-term rates are, when long-term rates are very low. So it's not as if there's more, it's not as if, Fed buying more assets is a huge difference in terms of the economic outlook. So it's good what they said, but the fiscal issue is really at the center stage at this point. The economic recovery, I think, is certainly taking place. When we get the third quarter GDP, we'll see a very big rise in economic activity in the third quarter. But if you look at the slope of that recovery, I think it probably will find out that it flattened out pretty significantly beginning in the second half of July and into August. And that's just because the pandemic started to become more widespread across a greater number of states. And so, the opening up of the economy essentially was put on in a lot of different places. If you look at the Fed's summary of economic projections, I think they're pretty reasonable. No return to full employment through 2022, no achievement of the 2% inflation objective through 2022, and no interest rate hikes through 2022. So the Fed is basically telling markets that we're going to be in a period of very low interest rates for a very, very long time ahead. Now, the markets have taken this all quite positively. Obviously the Fed's special liquidity, they do backstop markets and they create a buyer of last resort that basically reduces any illiquidity premium in the markets. And so that's one reason why the markets are doing better. But I think it's also just a low interest rate environment and underpins risk assets. People don't want 60 basis points investing in 10-year treasury notes. They want to earn more, and that pushes them out into the equity market, into the corporate bond market. In some ways, the fiscal support may have artificially painted a bit better picture of how things are than how they really are, because market participants aren't really putting much weight on the fact that the long-term fiscal outlook for the U.S. is quite disturbing. So we'll see how it all plays out. I think when I look at the markets, I'm not so worried about the equity market because it doesn't look to me particularly overvalued relative to bonds. But when I look at 30-year Treasury bonds, moving around 1%, that seems like pretty excessive. If we're actually going to have success in restoring the economy to full, within a few years, then 30-year bond yields are going to have to move up quite significantly at some point during that transition. So with that, I'm happy to start a conversation.
Great, thank you. We have a couple of questions that have come in, and folks would like you to elaborate more, particularly on the inflation target. So the Federal Reserve has been trying to get inflation to 2% or higher for an extended period of time. Do you think all the structural changes that we're seeing lately, such as working from home and reduction in the globalization, will make it easier or harder for those targets to eventually get hit?
Well, I think there's sort of two things going on. One, a short-term effect that's going to be mostly pushing inflation down, and then a longer-term effect that's mostly going to be pushing inflation upwards. The short-term effect is just the fact that there's plenty of excess capacity, and the unemployment rate's very high, and a lot of people are out of work, and that's an unusual environment for inflation to sort of manifest itself. Medium term, though, I think there are a potential source of inflationary pressures, which is mainly going to come through lower productivity growth. To the extent that we rejigger supply chains and make them a lot simpler and bring activity back to the U.S. isn't going to be as productive in terms of producing goods and services as maybe China is in certain areas. And so that's going to increase costs. Building in greater redundancy of supply chains is also going to increase costs. So I think that there's probably going to be a productivity consequence of what's happened that will eventually feed into inflation. But at the end of the day, inflation's about, pressure on resources. It's going to take a few years for that pressure on resources to really materialize. So I guess I'm not too worried about the inflation problem over the near term, but I certainly think that the Fed can succeed in getting inflation back to the 2% objective over the longer term. In terms of the Fed's 2% inflation target, I mean, the reason why they're so focused on it is that every year you spend below 2%, that puts downward pressure on inflation expectations. And the Fed's worried that the US could end up looking like Japan, where inflation expectations are quite a bit below the Bank of Japan's inflation objective. And when that happens, that's a de facto tightening of monetary policy because real rates of interest climb. And so that's really what the Federal Reserve is trying to avoid. A lot of discussion in terms of the Fed's long-term monetary policy framework about whether the Fed might raise their inflation target. That's not going to happen. The Fed's inflation objective is really set for them by Congress. Congress has said they want the Fed to achieve maximum sustainable employment and price stability. The Fed has stretched price stability all the way to 2% inflation, but I think it's very hard for the Fed to move to a higher number just to have more room to be able to ease monetary policy on the downside when you actually have a recession. I also think the Fed, is pretty committed to 2% inflation because they've managed to get inflation expectations pretty well anchored around 2%. I mean, inflation expectations are probably a little bit below 2%, but only marginally below 2%. And the Fed's not going to want to give up those gains by moving to a new inflation objective. So I think on the Fed's long-term monetary policy framework, all we're going to see is a very subtle change in how the Fed thinks about inflation. They're going to go from the current policy, which is a bygones policy, which is every year you want to hit 2% inflation, regardless of what happened to inflation in the past, to an average 2% inflation regime where you're trying to hit 2% inflation on average, which means if you're below 2% inflation for a while, you're willing to tolerate inflation above 2% for a while. In fact, you want inflation above 2% for a while. So that's, to me, probably the biggest consequence of the long-term monetary policy framework review. And we'll probably see that, we'll see that certainly this fall and maybe as early as September.
Okay, thanks. The federal government's budget deficit has ballooned to historic proportions based on efforts to navigate the economy through this difficult period. Do you think the federal budget deficits matter? And if so, will deficit reduction be a theme in later years?
Well, I think, I mean, if you thought budget deficits didn't matter at all, then why do we have taxes, right? Which is just run a lot of budget deficits. So, I mean, obviously there's a consequence in terms of, there's intergenerational cost of having more debt, and generations have to pay the interest on that debt. But economists' views about the federal debt have become much more benign in recent years, and that's because the level of real interest rates has been so low. And so the cost of accumulating federal debt has been much more modest. I mean, if you look at the level of federal debt today, it's probably 3 times the level of federal debt that we were prior to the great financial crisis in 2007. But debt service costs have moved up, maybe, I don't know, 10, 15, 20% only. So that's all because interest rates have come down. And so the debt service burden has stayed very manageable despite the large buildup in debt. Now, it's all fine as long as interest rates stay very, very low. But you can certainly imagine a situation, 5 or 10 years down the road, where people start to become worried about the level of debt. Bond risk premium in the bond market starts to increase. The dollar starts to weaken. That generates even more inflation, or leads to higher interest rates. And then all of a sudden, debt service costs start going up very, very rapidly. And then you really start to get into worries about the sustainability of the debt. I mean, this happened to Canada back in the early 1990s. They got into a situation where they had big budget deficits both at the federal and provincial level. And so the cost of borrowing went up pretty dramatically. And it got so expensive for the Canadians to borrow that they actually were forced to do fiscal consolidation. So I think at some point, U.S. is going to get to that point. Now, I don't know how long it's going to take. It's obviously going to take a lot longer than I thought. But, a really good adage in economics is there's no such thing as a free lunch. And so if you believe that deficits can just be as large as you want and grow as big as you want, you're sort of believing that there's a free lunch, and I just don't believe that.
Okay, and as a part two, there's central banks have played a pivotal role in keeping markets functional in periods of stress, like the Great Recession and this year. Is it important? Is the importance of the central banks increasing? And is there a potential for moral hazard, i.e., participants taking on too much risk?
Well, I think the central banks have become more important, but only because we've had more market, problems. If you look, if you look prior to, say, the mid 1990s, there weren't very many episodes of true market, the markets truly seizing up. And then you had long-term capital management in 97, and then you had the great financial crisis, 07, 08, and now you have this. So it looks like every 10 years we have a pretty significant market event that requires a Fed intervention of some sort. And I think the Fed was right to intervene in financial markets because you don't want innocent bystanders to be ruined, and you don't want to take down the economy just to teach some people a lesson. But there is a moral hazard. I mean, the Fed basically intervened and bailed out hedge funds that were highly levered in a trade where they were long off-the-run treasuries and short treasury futures to pick up a few basis points. They bailed out agency mortgage-backed securities REITs that had highly leveraged positions in the agency MBS market. They sort of bailed out the high-yield debt market by having a corporate credit facility that actually did extend a little bit into the high-yield debt market. And there are consequences of that, because basically what it's telling private market participants is that whenever things get really bad, the Federal Reserve will intervene to bail you out, and that basically essentially takes away a little bit of the risk that the private sector should be bearing in their decisions about whether to hold of given asset class. And so by doing that, it makes the risk of another episode greater. So every time this happens, it's sort of encouraging people to take on more risk, which then creates more risk of a crack up, which then forces the Fed to intervene, and that's not a great cycle to be in. All of you, if the financial crisis has happened once every 50 years, the moral hazard problem is probably not very material, because the people that were bailed out are now dead. But if it happens every 10 years, then I think it really gets baked into the memories of market participants and really starts to affect their behavior on an ongoing basis. And so I think we do need to be a little bit concerned about the moral hazard issue going forward. And I find it very odd to hear me saying that, because I've never been a big person that's been pounding the table about moral hazard. But I think there is an issue that we are experiencing this time.
Thanks. There's a ton of questions coming in, and I'm just going to ask you a few of them as we go along. I don't know if you see them along the chat side. As you do this interview, there appears to be many risks we are currently facing. How do you structure your thoughts and the implications for, and this is a four-parter, the economy, the U.S. economy, the global economy, emerging markets, and sector risks?
Well, we've already talked about the U.S. economy, and I think that the rest of the world, in terms of developed economies, are actually doing better than us, because most of them have managed the pandemic better, and so that's enabled them to open up more. And it's also caused people to be able to relax their social distancing. I mean, even if you completely, on paper, open up the economy, if the coronavirus is still very rampant, people are still not going to participate in the economy, and so it's going to have quite an impact. So the U.S. is actually doing, I think, more poorly relative to other developed economies. Relative to some emerging market economies, the U.S. is, very similar. I mean, or maybe even a little bit better than, countries like Brazil. But what I worry about really is not so much Europe and Japan. I worry mostly about emerging markets and emerging market debt, because it seems to me that they're one of the consequences of this pandemic and the sudden stop in global economic activity is it's going to be a pretty huge shock to emerging market economies. That's going to play out through commodity prices. It's going to play out through a reversal of capital inflows to capital outflows. And there really hasn't been a great mechanism yet developed for how we're going to deal with that on a collective basis. The movement away from multilateralism and international cooperation creates a little bit of everybody for themselves, and that is not a great way to cope with what's going to actually happen in emerging market economies over the next 6 to 12 months. I really do think there's a real risk of a hard landing, of a real crack up there. And I think, I haven't seen anything yet that suggests that we're going to avoid such a hard landing in the emerging market economies.
Are you worried about any tail risks at the moment? Do you feel that the economy is prepared for the challenges facing infrastructure, technology, healthcare, and security?
Well, I think, I think there's a lot of, risk in the sense of, the corona pandemic has changed, how people behave and how people go about work and how people, what their consumption basket is. And, what that implies is that, the capital investment that we had is very misallocated relative to the future that we're actually going to experiencing. Now, maybe we'll go back to how we behaved in the past very, very quickly. And so that capital misallocation will be very modest. But maybe if people will work more from homes and people might change their consumption basket, maybe the misallocation of capital is more significant than we think, and that could be a problem for financial markets. I mean, just think about airline travel. If more people do work remotely and people travel less on business, that has huge consequences for the airline industry going forward. And I don't think we have a very good sense yet of what the new normal is going to look like.
Okay, great. This is a question from Lawrence. The Fed's objective in lowering interest rates is usually to get people and companies to borrow more to make investments. But over the last 2 years, lowering rates has not achieved this goal, as companies are still uncertain about the future. If this doesn't increase borrowing, what is the point of lowering rates?
Well, I think that there's still a benefit of lowering rates. One, it makes the debt burdens that people have more affordable, right? So they can manage their debts without defaulting. So the number of insolvencies would be lessened by lower interest rates. Number two, lower interest rates supports financial markets, which supports wealth, supports financial conditions, and that also, underpins the economy. So, I mean, I think it's fair to say that the economy is not doing well, even with the Fed support. But if the Fed hadn't been providing this kind of support, the economy would be doing even worse. So I don't think it's fair to say that because the economy is not doing well, the Fed hasn't provided any support. I think the economy is doing better because of what the Fed's done. It's just that what the Fed can do is quite limited because the pandemic is creating a huge hole in income, and the Fed can't really do anything about that hole in income. That's really for the fiscal authorities to deal with.
Another question from Larry. Your views on the dollar. Will it continue to be the reserve currency over the next 5 to 20 years?
Well, I think in the very short run, I think we've seen the dollar weaken because we've done a poor job handling the coronavirus than our counterparts in other in Japan and Europe, Switzerland. So I think the weakness of the dollar really probably mostly reflects that that underperformance. In the short term, in the medium to longer term, though, I think the dollar probably is going to be the reserve currency of choice for quite a long time for a couple of reasons. One, we have very deep and liquid capital markets that facilitate transactions using the dollar as a currency. It's very attractive. Number two, we have open capital markets and a fully convertible currency. You can imagine that China might want to see the renminbi emerge as a competitor to the dollar, but for that really to happen, the Chinese have to be willing to actually have a fully convertible currency without capital controls and without the ability to put capital controls in place when the situation changes. So I don't think that they're really going to be a competitor in the near term. Europe potentially a competitor, but they need to move to greater integration to be a truly viable competitor. Now they made a small step in that direction through the budget initiatives that they just recently enacted, but I think that Europe is too disjoint to really be for the euro really to be a competitor for the dollar in the near term. So I sort of feel like probably the dollar for the next 10 or 20 years After that, it sort of depends on how we perform. You know, do we manage our economy well? Do we have credible monetary and fiscal policy? And do viable competitors emerge that can offer similar sort of terms and conditions for their currency?
And this is a question from Dan. How do you feel about universal basic income, and is it worthy of a discussion?
Well, it's a very political subject, right? Should you provide people income even if they're not working, regardless, and without any sort of pressure to find employment? I think that so trying to skirt around the political question of a bit. I think that the biggest problem I think is from a fiscal perspective. It's very expensive. I mean, to offer a basic income that's big enough so that people actually could potentially live on it without having to work would be extraordinarily expensive. And number two, you do have to think about the disincentive to think that it creates for work, and I think that'd be something that you have to look at, I think, pretty carefully. I don't think it's going to happen. I mean, I think that there are people on the left wing of the Democratic Party that are interested in basic income, but I just don't think that's a mainstream view at the current point. And the fiscal situation, is I think very much inconsistent with that, with the cost of that.
This question comes in from Patrick. Given the magnitude of the particular shock to the economy due to COVID, sentiment seems remarkably resilient. For instance, the stock market is exuberant, and while consumer confidence has indeed dropped, it has not come near the depths of the global financial crisis. Do you think investors and consumers are correct in viewing the coming economic recovery, and I know you touched on this before, as likely to be somewhat faster or better, or lack of a better word, than the last one?
Well, I think that there's sort of two phases for the economic recovery. The first phase is where people just resume their normal activities, and if they resume their normal activities, the economy is going to come roaring back, and that's what we saw in June and the first half of July. And as we continue to make progress against the coronavirus and hopefully develop a successful vaccine, then people can return to their normal activities, and the economy will bounce back quite considerably. Now, it won't bounce all the way back because there's going to be a lot of damage to household balance sheets, corporate balance sheets, and to the federal balance sheet. Fiscal policy will probably have to probably move in a more restrictive direction. So I would think that there's sort of two phases. There's this rapid growth phase where you bounce back, and then there's a much more sluggish phase, similar to what happened following the Great Financial Crisis. I mean, I think it's interesting that if you look at the Federal Reserve projections by the FOMC participants, they don't see the economy getting back to full employment until after 2022. So they're saying that there'll be a bounce, but the bounce will not be sufficient to take the economy back to full employment anytime soon. And I think that's a reasonable forecast. Obviously, a wild card in all this is going to be, is there a vaccine? Is the vaccine effective? How fast can it be? How fast can these vaccines be wheeled out? And I'm pretty sure there's going to be a vaccine. I don't know how effective it's going to be. I don't know how hard it's going to get to distribute and get take up of the vaccine. But that's clearly the next step of the recovery from the coronavirus.
What do you see as the greatest similarities and differences between the current economic challenges and the ones during the Great Depression and the Great Recession? And that comes in from BJ.
Well, obviously, the biggest difference is the healthcare component of this one is completely unique to this particular cycle. Number two, I think the banking system, the core banking system, is much safer this time than either the Great Financial Crisis or in the Great Depression. I mean, in both of those crises, the banking system was really an accelerant of the downturn in economic activity. This time, the banking system is holding up quite well, even despite a very bad economic outcome. So I think the regulatory changes made subsequent to the Great Financial Crisis in terms of tougher capital requirements, tougher liquidity requirements, stress testing has made the banking system a lot more robust. I think where we still have weaknesses in the financial system in the United States is really on the non-bank financial sector. I mean, you look at the money market mutual funds. Well, we supposedly fixed them, but yet there's another bailout of money market mutual funds this time around. There's still a lot of leverage that takes place outside of the core banking system, and we saw some evidence of some of the damage that can cause. But I think this crisis is very different in the sense that I don't think that the financial sector is playing an important role in accelerating or intensifying the downturn. And I think that was not the case in either the Great Depression, where we had a bank holiday, or in the Great Financial Crisis, when we had the locking up of the financial system almost completely in the fall of 2008. So I think it's very different in that sense.
You mentioned healthcare, you mentioned the COVID and healthcare being a differentiator. We have questions coming in from RG. Do you see the single-payer healthcare as a strong possibility post-election? The model of employer-provided healthcare appears broken given the experience of so many losing their jobs and consequently healthcare during the pandemic. Should this happen, could it spur business formation as it obviates a serious risk for many?
Well, it's interesting. The healthcare system we have is a historical accident caused by wage price controls during World War II. And companies were having trouble attracting workers. And so they said, well, okay, how can I get you to come work for me? Well, I'll offer you a healthcare benefit. And so that's really how the corporate healthcare process, or healthcare insurance process worked in the US. And that's what we've lived with ever since. I don't think we're going to be moving to a single payer system anytime soon. I think that the two presidential candidates, neither of them are in favor of it. I think if Joe Biden became president, I think we might see a gradual movement in that direction. By he's talked about lowering the Medicare eligibility age from 65 to 60. So you might have a slow walk towards a single payer system, a Medicare kind of system for all, but it would be a very, very a slow walk. So I don't think a single payer system is going to happen in the U.S. for quite a long time. And another reason it's probably very difficult for it to happen is there's a lot of vested interest. I mean, the healthcare represents 17% of GDP in the United States, roughly. And to say you're just going to restructure that entire sector of the economy, which is almost a fifth of the economy, and basically change all the relationships in terms of how people do their business and get paid, you're going to have a lot of political opposition to that.
We have a question coming in from Delilah. If leverage in the non-bank financial system is such a risk, don't low interest rates and QE exacerbate this more? What are your recommendations on managing those risks?
Well, I think the issue that people have raised about the low interest rate environment is could it lead to zombification? So companies that are basically broke but limp on because their interest rate costs are so low. I think that that was a problem in Japan. I think the U.S. That's a risk, but it's not like highly levered companies. Their interest rates aren't zero. They still have to pay a risk premium, and that risk premium is higher if they're more impaired. And so, I guess I don't see that being a huge problem for the U.S. I mean, one thing that's always stood the U.S. in good stead is when we have a problem, a period of turbulence in financial markets and the economy, we see the rapid redeployment of capital and of labor. And so the economy is quite flexible in responding to changes in economic circumstances. And that makes the U.S. economy, I think, more productive over time. And I think that will still happen. The low interest rates will slow that process down a bit, but I don't think it will forestall it altogether.
Okay, this comes in from Sam Loft. You make the case of Fed action benefiting debt holders and capital markets. What is your message to the non-market participants and savers?
Well, the Fed gets criticized for doing things that support financial asset prices, and the fact that financial asset prices disproportionately, benefit the balance sheet of wealthy people, and so there is wealth distribution consequence of the Fed's actions. And that creates a bit of a problem for the Fed from a public relations perspective. And, what the Fed has to explain clearly to people in the public is that, this is a question about alternatives. And, the Fed could not do this. Financial asset prices would be less elevated. The economy would be worse. And so you'd have more even distribution of wealth, but you'd have a worse economy. And so the Fed is doing this not because they're trying to generate a more skewed distribution of wealth and income, but they're doing it because they're trying to generate a strong, healthy economy. But I think it's important that the Fed needs to say this repeatedly because, one of the problems that the Fed faces is that people feel that the Fed is sort of all powerful. It's like, well, why doesn't the Fed just fix income distribution and wealth distribution too? Why is it stopping at just supporting market function and, lowering interest rates for, large businesses? And the answer is that's all the Fed has in its toolkit. I remember during the great financial crisis, people would come in to visit me at the Fed all the time and proposals of what the Fed should do. And I used to joke to people that about 2/3 of what people suggested were actually illegal. They weren't allowed under the federal code. For example, like people are even now are talking about should the Fed go out and buy equities? The Fed is not allowed to buy equities. The Fed is allowed to lend, and the Fed is allowed to lend in unusual and exigent circumstances, such as we have today, pretty broadly. So that's the justification for the corporate bond facilities, for the municipal bond facilities, and such. But there's nothing in the Fed's mandate that allows them to go out and buy equities.
Philip Clemens asks, inflation, deflation, no change, over what time horizon?
Well, I think what's going to happen over the next year or two, we'll probably limp along, somewhat below 2% on core inflation. I mean, what happens to overall inflation will really depend a lot on, the trajectory of energy prices. I mean, if energy prices stay where they are, then the energy sector will be pretty neutral for the inflation outlook. But you could certainly imagine that the downturn in oil production in the United States could eventually lead to a snapback in energy prices. So that could push the headline inflation up temporarily above 2%. If that happened, I think the Federal Reserve would mostly ignore it. I think the Fed's going to be basically focused on underlying inflation. And I think their view, and I would share that view, is it's probably going to be a while before we have enough pressure on resources to get core inflation back to a sort of 2% trajectory. And the Fed is going to be patient. They're not going to, I don't think they're going to tighten monetary policy until the inflation outlook, in other words, forecast inflation is expected to be above 2% and probably, not significantly above 2%, but 2.5% inflation or so before the Federal Reserve even seriously thinks about raising interest rates.
Questions just come in from Miles Ramsey. Could the Fed ever venture to regulate non-financial corporates in the way it presently regulates banks? For the stability of the credit markets, could the Fed ever institute minimum tangible equity ratios, maximum debt ratios, etc. for corporates?
Well, the Fed doesn't have that authority today. I mean, if you think about the non-bank financial sector in response following the great financial crisis, the Dodd-Frank Act established the Financial Stability Oversight Council to deal with systemic risk originating in the non-bank financial sector. And the Financial Stability Oversight Council really hasn't done much. The firms that they did originally designate as systemic have been designated, and very little has been done on the activities front in terms of designating securities as systemic. One thing I think, so the Fed doesn't have the authority to do it. So the question is the Financial Stability Oversight Council going to do more in terms of the non-bank financial sector? One thing I would like to see, and this might be a little controversial for people on this call, is I would like to see a requirement from the SEC that if an investment firm offers an asset that's very illiquid, that they can't offer that asset with overnight liquidity. So if someone's investing in a high yield bond fund, they can't get overnight liquidity. They can get maybe monthly liquidity because that's really more matched up with the actual liquidity of the underlying asset. I think it's, I think you create problems in markets where people's expectations are not aligned with reality. And so people think that they can get their money out of a high yield bond fund overnight. That's true most of the time, but when markets are under stress, that's a very difficult proposition. So I think it would be better to have monthly liquidity. And people complain about that. Well, oh, monthly liquidity, that'd be awful. My view is a very simple one. If you have enough money to invest in a high yield bond fund, that shouldn't be your first source of liquidity. So if you really need liquidity from your high yield bond fund overnight, that money probably shouldn't be there in the first place.
I don't actually think that's very controversial to many on this call. We've lived through a mismatch in liquidity during 08 and saw the ramifications of that. Questions coming in from Kunjan. With COVID, there is significant uptick in tech development and remote work. How do you see this as impacting the commercial real estate sector in the long run? Do you anticipate companies restructuring to a heavier work from home culture and lower real estate costs?
I think it's a really interesting question. I mean, I personally still feel that in-person meetings are better than video meetings because you have the prospects for the water conversation, just people stopping by without rising to the level of actually setting up a meeting. I remember during the great financial crisis, I actually sat on the floor of the markets group the whole time because I just felt that if I was there, more people would pop their head in and ask questions, and I'd have a little conversations. And I think that's really, really valuable. That said, I think we've found that people can work remotely a lot better than we thought. And so I think that will lead to some more flexibility in terms of remote working. I think the jury in my mind, though, is still a little bit out on remote working remotely. I think it probably works fine in terms of the status quo of doing what you've always done. But if you're really trying to change, a strategy or change something dramatically, I wonder if it's as easy to change things, remotely than it is if you're really, set up a skunk works and people are working face to face. So I think that's one area where I'd be wondering if you still need people showing up at work to work face to face. But I think the questioner is absolutely right. People like the fact they don't have to commute to work. I mean, in New York City, some people commute as long as an hour and a half each way. Skipping that and just plugging in at 8 o'clock in the morning, I think is a lot attractive to a lot of people.
I think you also see that in New York City, housing real estate prices as well have come down a little bit in the past couple of months. We have a question that's coming on cryptocurrencies, and do they serve a role in the global financial markets of the future? Gold has been a proven proxy store of wealth for generations. Alternatively, crypto theoretically is unconstrained by infinite new coin issuance. How do you compare and contrast its purpose in the future, and do you think it makes sense?
Well, I think you have to distinguish between, private digital currencies not backed by any real underlying asset from a digital currency that's backed by, treasuries or something that's of similar quality. I can certainly imagine a central bank at some point offering a digital currency to its population. Probably not going to happen in the U.S. for a very long time because we have such a large unbanked proportion of the population. But I can imagine one of the Scandinavian countries deciding that we don't really need to cash Swedish krona. We can actually have digital currency created by the central bank. So I think I think it's coming in that sense. And I also think there is some promise for cross-border transactions using digital currencies. I mean, I think the problem right now is that some of the digital currencies that have been most popular are not really well suited for that kind of cross-border activity. I mean, if you look at Bitcoin, for example, the throughput of Bitcoin is very limited in terms of how many transactions you can actually do per second. And the other problem you have with Bitcoin is it's not clear to me what happens after the Bitcoin production process ceases. If you look at Bitcoin, they're basically only supposed to produce a given finite amount of Bitcoins. But the production of the Bitcoins is really what pays people for checking out doing the ledger reconciliation. So if the Bitcoins are no longer being produced, then how do you incent people to actually do the ledger reconciliation? So I think there are, I think digital currencies are an interesting thing. They're certainly worth continuing to explore and develop. But some of the leading ones right now seem to be have more of a speculative element than a real business application at this point.
There's a couple of questions coming in on thoughts post the election. So I'll just summarize one of them. You have spent many years in public service as president of the Federal Reserve Bank of New York, as well as the vice chair of the FOMC. Would you have any advice for the next administration, whether it be Republican or Democrat, regarding policy settings as 2021 begins?
Well, I think, the most important thing is to get the pandemic under control. And so that means doing a better job on convincing people to social distance when appropriate, to shut down when appropriate, to do better testing, faster turnaround, better contact tracing. And if you do all those things, then you get the coronavirus under control. Then you can start to have a really, genuine, sustainable economic recovery. I also say, basically, be friendly rather than unfriendly to the Fed. I don't really think that it serves any great purpose to have an administration be critical of the Fed. It just sets markets on edge. The Fed's still going to do what the Fed does because the Fed, I think, is very apolitical. But I don't think it always raises the question, if you politicize the Fed and the Fed then acts, you're always asking the question, is the Fed doing what it's doing because it thinks it's the right thing to do? Or is the Fed doing something because it's under political pressure? And you really don't want market participants to ever have to ask that question.
How concerned should policymakers be with the worsening funding gap that lower interest rates are creating for the public pension system? And that comes from Chambliss.
Well, yeah, it's a huge problem for state and local governments, and it's exacerbated by the fact that the credit rating agencies take a pretty optimistic view about the outlook given some of these pension liabilities. I mean, it's true that at the end of the day, the pension liabilities are supposed to be, the debt obligations are supposed to take priority over every other obligation. But we've seen that when, municipal finances get really, really stressed, that even though in theory the obligations get first dibs on the resources of the governmental entity, that doesn't always happen actually in practice. And Detroit is a good example of that. So I would actually prefer to see the rating agencies take a little bit more tougher line with some of the municipalities that are not in good shape, because I think if they did that, then those states and localities would have to act more aggressively early, and that would actually make the problem more manageable over the longer term.
There's another question on state and local budgets. They've been blown up due to COVID. What role do you see monetary playing in order to help these governments?
I think that what's going to happen, I mean, the Fed's helping in two regards. One, interest rates are low, and two, the Fed has set up this municipal liquidity facility where it's prepared to buy municipal debt, and it has been buying municipal debt. So that provides support for market function in the municipal market. But that's about all the Fed can do. I mean, end of the day, I mean, I think there is a good case for, congressional aid to state and local governments so that states don't lay off workers. Because, I mean, the consequence of lack of support to state and local governments is there's going to be massive layoffs at the state and local level, which is then going to have consequences for the real economy in terms of its effects on consumer spending. We saw that during the great financial crisis. The problems with state and local governments led to a lot of layoffs among state and local workers, and that led to a more protracted recession, and it led to a slower economic recovery. So, I think we should learn our lesson from the last financial crisis and its aftermath, that forestalling those kind of layoffs at the state and local government level seems like a good idea at this point, especially in the middle of a pandemic where you have all these people at the state and local government. A lot of them are providing essential services that are helping us manage our way through the pandemic.
We have a question in from Richard. Why be concerned about moral hazard in a crisis? If it saves the economy, isn't that worth doing?
It absolutely is worth doing. That's why the Fed has behaved the way they had. But it's also important to understand that intervention does create a consequence because it can change expectations about how the Fed's going to behave in the future. If you always think that the Fed is going to come along and bail you out, you're going to take on more risk, and you're not going to fully bear the consequences of the risks that you're taking. And that's not going to be optimal from a risk-taking perspective, from a societal perspective. So you do want to take that on board. I think what you want to do is you really want to identify the weak spots of the system during peacetime and address them during peacetime, so that the Federal Reserve doesn't have to do these kind of interventions during wartime. I mean, in principle, you could have manage the buildup of highly leveraged positions in the hedge fund community in terms of long off-the-run treasuries and short treasury futures. In principle, you could have had a method of limiting that buildup of leverage. And if you had a way of limiting that buildup of leverage, then you wouldn't have had to have that Fed intervention. When you have the Fed intervention, you're basically saying, it's a bit of a get out of jail free card for the people that took on that leverage.
Richard follows up by saying he's not saying that the government should save everybody, but wouldn't it have been better off if the government had saved Lehman instead of letting it be an example to avoid moral hazard?
Well, we'll never know the answer of that. Right. I think that Lehman, though, in my mind, Lehman was not rescued, not because of a moral hazard concern, but because the institution was viewed as insolvent. And the Fed felt basically there's no buyer, and so we're basically lending into an institution that's insolvent. So all we're going to do is facilitate the run of private investors, and we're going to be left holding the bag of an insolvent institution. So I think from the Fed's perspective, there was no, it wasn't clear what the end game was and how this was actually going to help the situation. I also think that when people say, well, if Lehman had just been rescued, everything would have been fine. I don't really agree with that. Right on the heels of Lehman was AIG, and in subsequent weeks we had Wachovia, we had problems with Citigroup, we had Washington Mutual, and in my mind, things didn't really actually stabilize. Not even the TARP legislation stabilized the U.S. economy and the U.S. financial system. It really didn't get through the financial crisis until we got the bank stress tests in the spring of 2009. That was really when I felt like we finally were getting to the end of the great financial crisis. So if Lehman had been rescued, I think what would have happened is other things would have broken, and then eventually enough things would have broken to get you to the TARP legislation. You just got there by a different route.
Okay, so this is, we have time for one last question. We're just going to leave it with a very broad one. Actually, there's one in from Miles, and then we'll leave with the broad one. Does the Fed view corporate bankruptcy as a better option than continuing as a zombie company? Does the Fed's support of credit markets enable high-risk borrowers to sustain and increase leverage? And would it be better for these borrowers to restructure under bankruptcy law, given that the number of jobs cut is likely to be the same?
Well, I mean, the good thing in the non-financial corporate sector is bankruptcy is a pretty viable way of restructuring your debts, while in fact sustaining, in certain cases, your operations. So it certainly is a viable alternative. Where it's not a viable alternative is for large financial institutions, because as we saw with the failure of Lehman and the near failure of AIG, a bankruptcy leads to the rapid closeout of derivative obligations and total chaos in financial markets. So bankruptcy just doesn't really work for systemic financial institutions. So, the Fed interventions don't in any way forestall the ability for people to file for bankruptcy. And we've seen a lot of, large corporates file for bankruptcy over the last few weeks and months. So I think, what the Fed's doing is basically creating an interest rate environment that makes debt more affordable and more sustainable. But if you don't have a good business and you're not generating sufficient income to service your debt, you're still going to end up in bankruptcy most likely.
Thanks for that. So here's the broad question. What would your single biggest takeaway for us be today? What should we be thinking about?
Watch how the coronavirus pandemic is addressed. I mean, end of the day, if we do a good job, getting the coronavirus under control, both by how we practice social distancing and mask wearing and contact tracing and developing a vaccine, then we're going to be okay. And if we do a very bad job on those dimensions, then the economy is going to suffer. And so that's really the thing that's driving the show at this point. The second thing is really to focus on the fiscal outlook. Is Congress and the administration going to come to a deal on fiscal policy? Because the fiscal cliff is really, really, really big. I mean, it's far bigger than what we experienced in 2010 and 2011.
Well, with that, we thank you very, very much for your time today, Bill. Your thoughts and on the big picture of the markets and your countless factors are currently influencing. It was very fascinating for us to listen to. If anybody is interested in reaching out, Bill's email address is on the screen, so you can contact him directly with any questions that we might not have gotten to. Thank you again for joining us. Our next event is a pre-Labor Day Zoom cocktail. I hope all of you can participate in that. That's September 2nd at 5:15. With that, I hope everybody is healthy, happy, and has a wonderful end of the week. Thank you.
Thank you.
Take care. Bye-bye.